Hi everyone, this is James from The Value Thinker, and today we're going to present to you a course on options trading for beginners. I'm going to begin out with the goals and objectives for this course and the intended audience. If you have zero background in trading options, or if you're an investor with an interest in more strategies, this course is for you. Here, we're not going to use any complex equations or formulas. If you know your arithmetic, that's adding, subtracting, multiplying, dividing, that's all you're going to need. We hope that we're going to be able to add a powerful income generator to your portfolio. And what we're going to do is move you beyond the basics of buying and holding strategies. We're also at the same time going to help you embrace volatility a little bit instead of shying away. We're going to make sure that we add tools that you can use to systematically reduce the risk in your portfolio. And lastly, we hope that we're going to demystify all the languages and mechanics around options trading. Here are the range of topics that we're going to be covering in this course. So grab your coffee or favorite tea or any beverages and a pen and paper and sit back and enjoy the ride. You will hear me repeat things many times and go into the small nuances because it really helped me learn option trading the first time around. So don't be afraid to pause the video, rewind it, and watch it over again many times. There are two types of options, a call option and a put option. And with every type of option, there are two actions that you can take. You can either buy the options or you can become the seller of the options. In this course over here, we're going to focus on selling options and in particular, cash secured put options. Before I jump into the course details, I want to start off with a story to help you motivate for this topic. So here's Jane. She recently bought an expensive car and she's worried about driving it around the city and causing damages or God forbid getting into an accident. So Jane looks at her local insurance company and decides that she wants to enter into a contract between herself and the insurance company to protect her car in the following manner. Jane's going to have to pay an upfront fee in order to do this. Let's call that fee the premium of this insurance contract. So Jane, from now to the end of next year, any time in between, she's allowed to exercise her right in order to sell the car back to the insurance company at a predefined price. Let's look at the details of this contract a little bit more further. So first of all, today's November 28, 2025, and Jane would like this contract to expire by November of 2026. So roughly about a year. She has to pay a premium of $1,500. And remember what the contract does. It gives her the right. Again, I emphasize the right and not the obligation that should she decide to exercise this right anytime from now to November 26th of 2026, she's going to be able to sell the insurance company the car back for a predefined price of $40,000. So I know you're sitting there and thinking to yourself, why would I enter such a contract with Jane where my upside is limited to the $1,500 and my downside is a whopping payout of $40,000? Well, first of all, you're getting paid the premium up front. Secondly, if you observe the economy, this is happening on an everyday basis where insurance companies like Allstate, Geico, and other insurance companies sell out these packages in the hopes that they will expire worthless. So for any rational player, in order to enter such an arrangement as an insurance seller, that means that their probability of success, the probability of them making a profit must be very high. And that's the only reason why they would do this. This is the central theme and concept of this whole course, and we're going to develop this rigorously. Let me take a few minutes just to discuss these two studies over here. The first one being by Goldman Sachs. This is a study that's usually referenced by professional traders who are former Wall Street traders. And in this study, what they found was for a 10-year period that selling put options generated a higher return and less risk than actually buying the stocks. So if you look at this closer over here, you'll notice that when they were selling put options on these free cash flow companies, it outperformed stocks and at the same time had a much lower volatility. Here's a second study over here conducted by Tasty Live, which was formerly known as Tasty Trade. And in this study over here, you'll notice that these folks short or they sold naked put options. That's not what we're doing here, but the results are still very applicable. And in this case over here, you'll notice the win rate of selling these put options was higher than the win rate of actually buying or longing stock. Secondly, a very similar outcome that they found was by shorting these put options or selling these put options, the standard deviation, or you can think about as the risk, was lower than actually buying stock itself. Now we're going to put these two links down and below, and then you can look into these two studies a little bit further if you want to. So in this course over here, we hope that we're going to be able to help you develop a strategy where the risks that you have to take on are reasonable and something that you're comfortable with. We also hope that we're going to be able to add a tool to your portfolio that will allow you to generate maybe a passive income for now, and then with more experience, you'll be able to trade on a full-time basis. Lastly, what we want to do is achieve reasonable returns for the amount of risks that you're going to have to be able to take on. So the strategy that we've been alluding to is selling cash secured put options. We want to take a look at the return profiles of this strategy over here. If you're new to option selling, we recommend you to aim for essentially a return of 1 to 1.5% each month. On the surface of things, it doesn't look like a lot, but if you annualize this and compound it, it's going to be between 13 to 20%, which is quite sizable when you compare that to the S&P 500. For the more seasoned and experienced option sellers, most sellers will tell you that their aim is going to be between 2.5 to 5% per month. And if you annualize that, that's going to be a gigantic return with a reasonably safe strategy. The longer you trade options, the more you're going to hear about people selling weekly options, quarterly options, and even leap options. For the time being, we suggest you to stick to the monthly options. So before getting started, nothing in this video is investment or financial advice. Everything's education and entertainment only. Markets are extremely volatile, so do your own due diligence and research before making any investments. As usual, there's nothing to sell. We have no Discord or trading group. This video is not a sponsored video. If you find the information helpful, please consider subbing to the channel, giving this video a like, and pinging the notification bell. If you're on X, consider giving us a follow because we can tweet out the information faster than making a video. Let me start off by talking about a very important definition that is central to the understanding of this course and trading options. I'm going to drill down to the nuances to make sure that you understand the essence behind this definition. Let me start off with the definition of a put option. A put option is a contract that gives the buyer the right. Let me stop there and emphasize the right, but not the obligation to sell a stock at a specific price by a specific date to you as the seller. So in this case over here, the most important takeaway is that the buyer has the right, but not the obligation. Drilling down on this definition over here, recall that the buyer has the right to sell you the stock at a specific price. We're going to start calling this specific price the strike price, and by a specific date that we're going to start calling the expiration date. So going forward, every single options contract has a strike price and an expiration date. Looking at this in totality, and as a seller, there's one important thing that you must walk away remembering, that as the seller, you are obligated to buy each share from the buyer should they wish to exercise their right anytime from today to expiration date. Let's look at this from the perspective of the put seller. Whenever you sell a put option, you are essentially known as a put writer. And if we go back to that example of the car insurance and Jen purchasing insurance from the insurance companies, you'll notice that as a put seller, you are essentially selling an insurance policy to somebody else. In exchange for taking up this risk, you're going to get paid up front, and that was the premium that the buyer paid you in return for a promise that you have made. You have made a promise and you will be obligated to purchase the shares at a predefined price known as the strike price should the buyer wish to execute their right anytime from today to the expiration date. So I want to dive into a real world example over here. It's November 24th, 2025, and BMNR, which is BitMine Technologies, headed by Tom Lee, and for those of you who are fans of a DAT treasury, is trading at $26.95. We're going to look at a particular option over here, and you'll notice this option is on BMNR. It has an expiry date, it has a strike price, and then it's also a put option. So every single option displayed on what's called an option chain will have this information over here. So we're going to highlight the important details. The expiration date is about 40 something days away in January of 2026. You'll notice over here the strike price is $26 per share. And it will also give you details of the premium that the buyer would have to pay in order to engage in this contract. Now, let me clarify something that's very confusing about trading options. It's called the option multiplier. Although it's never explicitly stated anywhere, any option buyer and seller would know that one option contract on the marketplace stands for 100 shares. It means that if the buyer were to buy one option, it would give them control of 100 shares. To make this a little bit more confusing, these prices over here, the strike price and the premium, are quoted per share. So going forward, you need to understand that if you were to buy one contract, it controls 100 shares, but the details that are quoted, like the premium, is quoted per share. So continuing on with this example over here, BMNR is trading around roughly $26.95 on November 24th, 2025. This buyer over here wants to buy some options from you. And the options we've alluded to earlier, it has a strike price of $26, a premium of $4.60, and an expiry date in 40 something days. So you'll notice over here, the buyer decides to buy 3 contracts from you. Because of the option multiplier, that represents 300 shares. The buyer is going to need to pay you the following premium. It's going to be $4.60. And remember how I said it's confusing when you look at the option chain. It's quoted per share. But because there's 300 shares involved in this transaction, you're going to have to multiply that by 300 to get the premium that you're going to receive from the buyer. And this is directly paid to you. Before proceeding a little bit further, I want to digress and talk about some of the motivations of why the buyer would want to enter these contracts with you. So let's take this situation over here to learn one of the motivations why these buyers would enter such a position. So let's say here we have a buyer who thinks that crypto is entering a bear market very soon, and he thinks that BMNR is going to perform poorly. He's speculating that the stock price of BMNR is going to go down over the next little while. So this buyer goes out there, purchases 3 put option contracts from you, the seller, that will allow the buyer to sell you each share anytime from today until expiration for $26 per share. Let's hypothetically pretend that on expiration date, the stock is trading for $18 per share. So in this case here, the buyer is going to exercise their right to sell you a share for $26. And how they're going to profit is they're going to go to the open market, buy it for $18 per share, then sell it to you for $26 to profit the difference. So when we calculate the profit that the buyer earns per share, here's the calculation. There's that $8 difference that the buyer is going to earn by being able to sell you each share for $26. But because the buyer had to pay a premium to enter this position, the $4.60, we had to incorporate that into the profit that the buyer gets. In this case, when you do the calculation, it works to be $3.40 per share. And because he bought 3 options, that stands for 300 contracts. His total profit is going to be $340 multiplied by 300 shares to give him $1,020. When the buyer does his return on capital, remember that he put up the premium, which is the $1,380 to enter this position. So you'll notice over here, it gives the buyer a whooping 74% return. And that's the leverage from the buyer's perspective of why they would buy options. In this case, they're speculating. I remind you that we're option sellers, and there's a reason why we sell options, which we're going to dive a little bit further into later on. Let's look at a different situation over here, case B, to learn of another motivation why buyers would buy put options. So today's November the 24th, 2025. BMNR is trading at $26.95. This particular buyer decides that he wants to own the shares. So he goes to the open market and purchases 300 shares at that market price. Now, although the buyer likes the long-term outlook, he's worried that crypto winter is coming. So he decides that he wants some protection for his shares. So the buyer goes to you and purchases 3 options from you in order to create a price floor of $26 for his shares. So that means no matter what the stock does, it can never go under $26 because the buyer can exercise this right and sell away those shares for $26 per share. So in this scenario over here, the buyer is hedging the risks out of the position that he's in. He's hedging the risk as much as possible because should the stock trade down at $10 at some point in time, the buyer would exercise his right, sell all his 300 shares away to you at $26 per share. That means that he's protected from this market price of $10 per share. Now, in order for the buyer to get this benefit, he has to pay a premium up front. And based on what he thinks about that protection or the justification for paying that premium, he's going to come up with a price where he's going to be willing to pay for this insurance policy to ensure his shares from falling below $26 over a certain period. Before going on with the course, I want to discuss a few very important things. As Warren Buffett said it best, derivatives are financial weapons of mass destruction. In this course, we're going to give you some very powerful tools, but with great power comes with great responsibilities. Don't be like the hero Perseus from the Greek mythology, where he was given very powerful weapons, and before receiving the adequate advice of using them, he ran in and tried to slay the mythic creature Medusa. Lastly, I just want to briefly touch upon risks and volatility. As our commodity friends would say, that volatility is not risk in itself, but it is a component of risk. To me, risk in the pure sense is a probability-weighted possibility of having a permanent impairment of your capital, meaning losing your capital permanently. Whereas volatility is merely the emotional price that you have to pay to be on this journey. Ultimately, it is risks that will determine if you arrived at your desired destination more richer or poor, or if this pathway in itself destroys your ability to remain solvent long enough to stay in the game. If you're like me and been around volatile assets long enough to know that as soon as you think you have it figured out, the market humbles you. If you made it up to this far, congratulations. Give yourself a break, get up, get a beverage, get a break in, and return back fresh as we continue on with the course. Let's get back to example 1, where the buyer has purchased 3 options from you, allowing him to control 300 shares. You'll notice over here that the max loss for this buyer is the premium that he paid and put up for you. You also notice over here that this allows him to control 300 shares. So we say that this buyer is in a leverage position. Why? Because today, Bitmine is trading at $26.95. For the buyer to control 300 shares with his 3 options, notice when you do the math that works out to be about $8,085. But only with the $1,380, he was able to control 300 shares. This is what we call a leverage position. Lastly, remember that today is November 24th, 2025. And that the buyer has until January the 16th of 2026. That's about 53 days to expiration for this option over here. Most importantly, I must remind you that from now to expiration, the buyer has the right. He has the right, if he chooses to exercise, to sell you a share for $26 anytime from now to expiration. So in one of the motivations that I talked about, the buyer is speculating that the stock will go down. Here's another terminology we're going to throw at you. When somebody expects the stock or the economy to go down, we call them being bearish. So in this case over here, one of the motivations for this buyer is that they are bearish on the stock and hoping for it to go down. So now let's focus on you as the seller. In this case over here, you collected a premium of $1,380. That's also your maximum profit for this position here. What we also want to do is calculate your theoretical maximum loss. Remember here, you sold an option with a strike price of $26. The worst thing that can happen to you is if the stock went to 0. In that case, all 300 shares, because you sold 3 options, you're going to take $26, multiply by 300, which will give you a large loss of $7,800. However, because you collected some premium, that premium will offset your loss, so that when you take the $7,800 minus a premium, you get a theoretical loss of $6,420. You should also keep in mind the very important fact that you have an obligation now. Any time from now to the expiration date, if the buyer wishes to exercise their right, they're going to be able to sell you a share for $26, and you're going to have to buy those shares. I'm going to add in a few more things over here. Your risk in this case, you have a limited upside of the premium that you collected and a downside of a whopping $6,420 of a theoretical loss. The only way you would engage in this position as a seller is if you knew that your probability of success or your probability of profit goes up. Remember that we're also selling cash secured puts. We're going to expand on that definition later on. But 2 more terminologies that we're going to throw in here is, number 1 is if the market was trading neutral, if BMNR did nothing, or if the stock market's trading neutral, likely your put options are going to expire worthless and you're going to collect the whole premium. We're going to define that idea more rigorously later on. Likewise, if BMNR is thundering up, or if the market is thundering up, you'll notice that these options will also expire worthless again. Don't worry about that now. I'm going to expand on that. So the terminology that I want to introduce is that when you're hoping for these options to expire worthless in this position as a seller, you are either neutral or you're bullish on BMNR. Continuing on with our example with the buyer who just bought 3 options controlling 300 shares from you, let's talk about all the possible outcomes in this universe. The first outcome over here is when the options expire worthless. We say that these options expired out of the money. Later on, we're going to define this term a little bit further. The second outcome at expiration is if you were assigned the shares. What this means is that on expiration date, the buyer exercises their right to sell you each share for $26. And lastly, this third outcome makes up the majority of the course. We're going to teach you how to close out a position if you're winning anytime from now to expiration date, or defend a losing position. So let's get started and talk about outcome number 1. Let's look at the first outcome over here. I'll remind you that BMNR is trading at $26.95 and you sold those 3 options with a strike price of $26 that expires on January 16th of 2026. In this scenario over here, at expiration date, if the stock is trading much higher than the strike price, here's what's going to happen from the buyer's perspective. The buyer is going to look at this and they're going to go, why would I exercise my right to sell you a share at $26 when I can go to the open market and sell it for much higher to somebody else? So in this scenario over here, the buyer is going to forfeit their premium. They're going to end up losing all of that, and that premium is going to be transferred to you as a seller, and that's also your maximum profit as well. So let's examine your position in further detail. Here are the options detailed just to remind us of what's happening. And in this case, we're going to define what selling a cash secured put means, but in the context of calculating your return on capital. So remember that you sold 3 options, which is selling the equivalent of 300 shares. And what you're doing in this position is the following. You're telling the broker that in order for me to enter this position, I'm going to put up 100% of the cash required to enter the position. So at no time between now and expiration can the broker do what's called a margin call. Remember that the strike price that you sold out is $26. So if you take $26 multiplied by 300, the cash that you're required to cover the entire position is $7,800. And if you do your return on capital calculation, the profit that you just got, the maximum profit is the premium divided by the cash required to enter the position, and that's a return on capital of 17.7%. Now I'm going to talk about a diagram that a lot of option traders use. I want to start off by saying that you do not need to understand this diagram to be able to be a very good options trader. However, I must talk about it. The first thing I'm going to allude you to is that this diagram is at expiration. So this is called a P&L diagram, a profit and loss diagram at expiration. The x-axis over here stands for the price of the stock at expiration. And the y-axis over here stands for the profit and loss per share at expiration. You can quickly see at a glance, anytime when it's green, you know that as a seller, you're going to be in the profit zone. And anytime when it's red, you know that you're losing money. So this is going to be the P&L diagram for the options on BMNR that we just sold. Let us first start off by calculating the maximum profit. You can either logically reason this out, that because you sold these options at a strike price of $26, so whenever the price at expiration is at 26 or higher, you know that you're going to make a maximum profit. You can either do that, or you can read this off of the diagram. So you'll notice over here that on the x-axis, if the stock finished at $26 or above, you're going to make the maximum profit. So you want to find out what that maximum profit per share is. So you're going to go up to the y-axis and read that off of the graph, and you'll notice over there is $4.60. I know that you can't know exactly what this scale is, but if we zoom in, we're going to be able to tell that it's $4.60. Now, we already know this from the start of the trade. Why? Because the buyer paid us a premium of $4.60 per share in order to enter this trade. The next thing we're going to do over here is we're going to find the price of the stock at expiration where we're going to be at the break-even point. That's when on the y-axis over here, you'll notice that's when you're not making a loss and you're not making a profit. So you can either directly go across over here and then read down to the stock price and discover that that number is going to be $21.40. You can either read it from the chart or you can logically reason this out. And how you would logically reason this out is the following. You're going to say to yourself, if I sold these options over here, imagine in a world where I didn't collect any premium. Every time the stock goes under $26 by $1, I'm going to start losing money. So each time the stock goes down, I'm losing money. So in that scenario over here, and incorporating in the fact that when you sold this option, you collected $4.60 of a buffer. So what you're going to do is take the strike price of $26 minus $4.60. That's going to give you $21.40, exactly what you would have read off of the graph directly by looking at the P&L diagram. The second thing I'm going to say here is that all option brokers are going to have this calculation for you at expiration, and they're also going to have a dynamic model where they're going to model your P&L while the trade is going on by using some assumptions. So while this next example is not related to the first outcome where the options expired worthless, I just want to hammer home the message of understanding a P&L diagram with two more examples. In this case, we want to figure out what your profit or loss is when the stock is trading at $12.50 at expiration. So there's two ways of approaching this. The first way is looking at the diagram directly and calculating what our partial unrealized loss would be if the stock is trading at $12.50. Well, we can do that by looking at the diagram, and this is roughly on the x-axis, the stock price being at $12.50. We're going to go up, we're going to go across, and we're going to read what the partial loss per share is when the stock is trading at $12.50. In this case, that loss is about $8.90. And since we sold 3 options, which is 300 shares, we have a partial loss of $2,670. So either we look at the P&L diagram directly or we do a little bit of mental math. And here's how we're going to do the mental math. Remember that the strike price is $26. If the stock price trades at $12.50, and remember that every dollar under $26 means we're losing money. So from $26 down to $12.50, that's a vertical width of a loss of $13.50. That would be our whole loss if we didn't collect any premium. But remember, us as the seller, at the beginning, for every single share, the buyer paid us a premium of $4.60. That's our buffer against the $13.50 loss. So if we take $13.50 minus $4.60, that's going to give us a loss of $8.90 per share if we did the mental math or the logical math. And that's the same thing as reading that loss off of the P&L diagram. And finally, I'm going to give you one more example in this case. Again, this example is not related to the first outcome where the options expired worthless. I'm also going to emphasize that whenever we talk about P&L diagram, it's standard to consider them at expiration unless I say otherwise. In this scenario over here, let's pretend that the stock was trading at $23. We know that since $23 is in this green zone, by looking down at the x-axis, we must be making some kind of a profit at this stage. In this case over here, we can either directly read them from the diagram. So that's $23, the stock price at expiration. If we go up and go over to the y-axis in this case, it's going to tell us that we're going to make a profit of $1.60 per share when the stock finishes at $23. So in this scenario, since we sold 3 options, we're going to take 160, multiply by 300, and that should give us a profit of $480 at expiration over here. So you can either read that directly or you can reason this out with the mental math. So logically, you're going to say to yourself the following. If I sold the options with a strike price of $26, and if I didn't collect any premium at all, every $1 that the stock trades under $26, me as the option seller is losing money. In this scenario over here, $23 is $3 away from $26. So that means that I've lost a vertical whiff of $3 per share when the stock is trading at $23. However, keep in mind that to enter this trade, the buyer had to pay me a premium of $4.60 per share for me to engage in this contract. And if I take that $4.60 and I minus that $3 of a vertical loss, in that case, I would get $1.60 of a profit per share. And that's exactly the same number as what's showing on the vertical axis on the P&L diagram. So now we're going to go to outcome number 2, and it's at expiration date, and you want to be prepared for assignment. This means that the buyer is going to exercise their right to sell you each share for $26, and now you're going to start owning 300 shares. So if you are not mentally prepared for this, and if you do not understand what's happening, you're going to be in panic mode, and we want to prepare you for this. So let's look at outcome number 2 over here, where the stock price crashes at expiration date, and you end up getting assigned, and now you own 300 shares. Remember that in this BMNR trade, you sold out options with a strike price of $26. The stock will trade, and unfortunately, at expiration date, in this hypothetical example that we're going to use, the stock price crashes down to $10 per share. In this example over here, the buyer is going to execute their right. They're going to go out there and they're going to buy the stock for $10 on the open market, exercises their right, and sells it to you for $26 per share. What we want to do is examine what's going to happen in this scenario over here so you're mentally prepared. So here's you, and here's that expiration date. 2 things can happen. Number 1 is if you're assigned the shares, and that's exactly how the story will play out. Or 2 is you ink a loss, which we normally would never do. So in this example over here, we're going to look at the scenario where the stock is trading at $10 and what's going to happen to us. So the devil is in the details. So let's comb through those details over here. So you can think of it as the following. Right now, the options you sold has a strike price of $26 and the market price is only $10 right now. So you can think about your initial costs when you were assigned the stock because the buyer executed their right to sell you each shares at $26. So that's your initial costs. Remember that entering this trade, you collected a premium of $4.60 per share. That's your buffer discount in this scenario here. So if you take $26 minus $4.60, you can think about that your effective cost per share or your book value cost is actually $21.40 when you do the math. Now in this case over here, we want to look at what the market is valuing your current portfolio. Remember that the stock price is trading at 10%. Because you now own 300 shares, your portfolio is only worth $3,000 on the market. If you look at your account right now and don't panic, this is only an unrealized loss. from $21.40 down to $10, you basically have an unrealized loss when you multiply it by 300 shares of $3,420. Remember, this is not a loss yet until you realize it. So here's my last P&L diagram to make sure we hammer this message home of when the stock is trading at $10. Let's look at this diagram to find out what our loss is. Remember that on the x-axis over here, we are going to be looking at the stock price at expiration, which is $10. We're going to go up to the y-axis, and in this case over here, it's going to tell us that we're losing about $11.40 per share. Because we sold 3 options, our total unrealized loss is $11.40 times by the 300 to give us an unrealized loss of $3,420. You either look at the P&L diagram and directly read that, or you do some mental math. So remembering our mental math, the strike price is $26. If we are going under $26 for every single dollar that the stock price trades under 26, we're losing money as a seller. So from $26 to $10 is a vertical whiff of a $16 loss per share if we didn't collect any premium. However, in order for us to enter this position, the buyer had to pay us a $4.60 premium, which we'll call a buffer, that neutralizes part of that $16 loss. If you take 16 minus 460, that gives you the $11.40 loss per share, and that's exactly the same number as what the P&L diagram is telling us. Remember that this is an unrealized loss at this point in time. So we're getting to the most important part after being assigned a stock, and that's managing the trade effectively. I'm going to start off with the most important rule, which is also the foundation of selling options, is that you only sell options on companies that you love to own or companies that you're comfortable with owning when the economy turns against you. I'm not here to give you a valuation course or change your mind about how you look at things or how you fundamentally value stocks. But what I'm here to say is that for some of us, we like to own Tesla, not just because of its electric vehicle potential, but because it's also working on Optimus. And we project that Optimus will dominate the decatrillion robotic market that's yet to come. While others have a fundamental belief that the king will continue to cement its dominance in the chip market. And if you're not aware of Neuralink, which is a private company that's working on BCI technology, brain to computer interface, with its mental telepathy product, it's just absolutely amazing. You'll see some of the patients who are on that technology now who have either spinal cord injuries or other injuries where they've lost some of their motor skills. All they do now is embed the chip into their brain, and then they can carry out some of these amazing actions. So I want to hammer home the message that you only sell options on companies that you're comfortable owning during a downturn by looking at NVIDIA earlier in 2025. So notice here around March, NVIDIA was trading at $140. If you had sold options on NVIDIA and got assigned a stock, you wouldn't have been worried because you were comfortable owning NVIDIA anyways. In April of 2025, NVIDIA traded as low as $98, but if you were confident in NVIDIA, you would have been able to hold on, and then the stock, the rest of it would have been history. NVIDIA just ran off up to $200 and you would have made a giant profit. In my second example over here, it's going to hammer home the message that you should only sell options on companies you're comfortable holding during a downturn. As an option seller, my advice to you is do not go chasing for premium or chasing for volatility. Yes, you are paid a much larger upfront premium, but you also have to take on much more risks. I'm going to use Canopy Growth over here. In the early stages of 2020, the Canadian landscape for cannabis was just developing and the government was providing more clarity. There was a bunch of companies popping up like mushrooms. They all had razor-thin margins. They all had very poor earning and a lack of product differentiation. And as you can see from Canopy Growth's stock chart over here, they've lost now over time 99.6% of the share price, and they're never going to recover at this point. So let's get to our second point of the post-trade management. And in this case over here, if you like BMNR already, you're not going to like them any less when they go on sale. This is something that a lot of professional traders use before entering a position. It's called buying at a discount. So going back to our trade over here, today's November 24 of 2025 and BMNR The market price is $26.95. We just sold these options and collected a premium of $4.60 with a strike price of $26. That means that our effective cost, our book value cost, is the $26 minus the premium to give us a book value of $21.40. Now, if you compare that to the market price of $26.95, that's a whopping discount of 17%. Again, I emphasize the idea that if you like BMNR today, you're not going to like them any less when they go on sale. I'm going to give you one final example with Microsoft. And in this scenario over here, on November 26th of 2025, Microsoft is trading at $485.50. So you're going to go to the option chain and you're going to find this option that expires in January 2026 with a strike price of $470. If you sell this option, you're going to get paid $9 for the premium per share. That puts your new effective cost or your book value to be $461 should you be assigned the shares. In this case over here, if you compare it to the current market price, that's a 5% discount. So now, this is one of the most important points of the post-trade management, and that's the psychology and discipline that you have to have while trading options. Remember that when you were assigned in that example that we talked about, if you were assigned with NVIDIA and you panicked, you would have missed out large. Because the psychology and mindset of option trading is very important, I want to take a few minutes over here to provide you with some advice that you're going to need in the road ahead. Let's start off with the following. Options trading is often described as 10% strategy and 90% psychology. While technical knowledge provides the roadmap, your psychological state determines whether you're going to stay on this road or you're going to drive off of the cliff. The leverage inherent in options trading not only magnifies the financial gains and losses, but also the emotional peaks and valleys associated with it, making psychological resilience the primary determinant of long-term success. As part of risk management, you need discipline. Discipline is the only force that enables proper risk management. Without it, rules are just suggestions. As Paul Tudor Jones once famously noted, the most important rule of trading is to play great defense and not offense. The options markets are quite volatile. Undisciplined traders rely on intensity, big bets, they're glued to the screen with emotional highs, which tends to lead to burnout. Disciplined traders rely on persistency and consistency. They follow a prescribed routine checklist for entry and exit, making their trading boring but very profitable. And the last point I have to emphasize about your post-trade management once you've been assigned the shares is your risk management, which we're going to talk about these topics a little bit later on. So if you made it to this point, congratulations, you're doing very well. It's time for another break to freshen up and then coming back for more material. So now we're going to look at outcome number 3, which makes up the majority of this course. So in outcome number 3, we're going to talk about 3 topics that are very important. Starting with number 1 is closing a position when we're profitable. Secondly, over here, you're going to find that a lot of new option traders and some experienced ones will always wonder the following question. What happens if the buyer of the option decides to exercise somewhere between today and expiration date? You'll see that after our thorough discussion, this usually never happens. And lastly over here, we're going to learn how to play great defense, because when we're down in a game, that's when we're going to be able to turn it around. But before we discuss these 3 important topics over here, we want to talk about some definitions that are fundamental to our understanding and also for the rest of our options trading career. So here's the basic idea over here. We're going to break up the economy or the stock in 3 different states. So when the market is roaring up over here and we're bullish about things, this is good for us as the seller. Why? Because the stock price will be so much higher than the strike price that it's going to render the option worthless. In this case, this is good for us. Likewise, when the market is neutral and just trading sideways and the stock isn't doing anything, that's also good for us because the option is going to likely expire worthless. And lastly over here, if the market takes a deep, sharp dive down, that's when it's not so good for us. So we just think about this as a linear probability of 3 states. 2 out of the 3 states, or 66% of the time, it's going to be in our favor as option sellers. Lastly, I just want to mention over here that even if the market dips slightly or the stock goes mildly bearish, we're still going to be in favor and our option is likely to expire worthless, which is good for us as option sellers. So now here's the second idea over here. It's the relationship between the strike price and the stock price or the market price of the underlying stock. In this case over here, I want to introduce the terminology of ITM, ATM, and OTM, which stands for in the money, ATM is at the money, and OTM is out of the money. So diving deeper into those definitions over here, let's assume that we have an option that has a strike price of $26, and let's look at these three different states. First of all, what does it mean when the option is in the money? In this case over here, it's good for the buyer. Why? Because let's say that the stock price is $20 here. It's less than the strike price. So in this case, the buyer is going to go out there in the economy, they're going to purchase a stock for $20, and they're going to exercise their right to sell it to us at our strike price of $26. So in this case over here, from the perspective of the buyer, we're going to say that when the stock price is lower than the strike price, the option is in the money from the perspective of the buyer. Let's look at the other alternative over here. When the option is out of the money. So when the option expires out of the money, that's good for us as the seller because the option is going to expire worthless. In this example over here, the strike price being $26, the stock price right now is $30. So the stock price is higher than the strike price. In this case over here, the buyer would say, why would I sell it to you, the seller, for $26 when I can go and sell it to somebody else for $30 itself? So in this case, the buyer is going to forfeit their premium. The option is going to expire worthless when the stock price is higher than the strike price. And the last definition over here is ATM for at the money. In this case over here in my example, the strike price is $26. Let's call the stock price for the time being $25.50. Whenever the stock price is equal to or close to the strike price, we call that at the money option. Why? Because it has a 50-50% chance of either going up or going down. So now let's apply these definitions of in the money, out of the money, and at the money to a real life example. You'll notice over here that it's November 26, 2025, and Nvidia is trading at roughly $180.24. And this is the option chain for Nvidia over here that has an expiry date of January the 16th, 2026. You're going to notice that I placed the stock price somewhere here. And the broker usually makes your life very easily by highlighting whichever options that are in the money and then not highlighting the options that are out of the money. This makes it very easy for you at a bird's eye view to know which one's in the money and which one is out of the money without thinking about the definitions. Let me first start off with the ones that are in the money. Why are they in the money? Well, that's because the stock price is lower than the strike price. So from the buyer's perspective, they're going to be able to go into the economy, buy the stock for 180, and then exercise their right and sell it to you at either 186, 187, or wherever the strike price that the two of you engaged in. Now, let's look at the out of the money options over here. These options are out of the money because the stock price, again, is higher than the strike price. So in this case over here, the buyer of the option will say, why would I sell it to you for $176 when I can go out there and sell it to somebody else for $180.24 on the open market? Now, when the stock price and the strike price are close enough, like in this example over here, we call those strike price at the money. Well, 180 is close enough to 180.24, and in this example, I arbitrarily just chose 179 and 181 to call those ones at the money. In reality, you'll notice that the broker highlighted 181, and of course, we know that that 181 is an option that's in the money, and the 179 strike price we know is an option that is out of the money. So in summary over here, you'll notice that I came up with this table that's easy to read and understand for in the money options, at the money options, and out of the money options. And finally, let's go over these two important definitions of intrinsic and extrinsic value. So whenever the buyer pays us a premium, that's the price of our option. And the equation for the price of the option has two components: the intrinsic value, which we're going to call the real value, and the extrinsic value, which represents the time value and the volatility of the option itself. So let's put those definitions to practice over here. First of all, with the intrinsic value, which I said was the tangible part, it's the real part of the option. And for put options, the intrinsic value stands for the amount that the stock price is below the strike price. If you look on the side over here, this is alphabet. We're going to use this example to understand intrinsic and extrinsic value. So Google is trading at about $320.12 on November 28. Here's an option that expires on January 16, 2026 with a strike price of $335. You should start already thinking in your mind that because the stock price is under the strike price, this option is in the money. Why is it in the money? Because the buyer can go out there, buy the stock for $320, exercise their right, and then sell it for you for $335. That's why this option is already in the money. In my example over here, the premium or the price of the option is $23.40. So let me represent that $23.40 by this green line over here. So if that's the price of the option, remember the option equation, the price is equal to the sum of the intrinsic value plus the extrinsic value over here. Remember what the definition of the intrinsic value is. The definition of the intrinsic value is the amount that the stock price is under the strike price. So if the strike price is $335, if we subtract the stock price, we're going to get our intrinsic value, which is represented by the blue $14.88. So now we know the intrinsic value. We know that the price of the option is equal to the sum of the intrinsic value plus the extrinsic value. So if we take $23.40 and if we subtract the $14.88, we're going to come up with an extrinsic value of $8.52. So let me tie things together with this alphabet example over here. One of the very important things for you to realize over here is that the intrinsic value can never be less than 0. If the option is out of the money, then by definition, we assign the intrinsic value to be equal to 0. You must know that the relationship between the option strike price that you saw early on and the current market price or the stock price determines if the underlying stock has an intrinsic value. So let's use another example to understand the concept of intrinsic and extrinsic value. Remember that the extrinsic value is the extra stuff that the buyer is paying you over the intrinsic value. In my example over here, on November 28, 2025, Lululemon is trading at $184.18. If you look at this option over here that expires in about 40-something days in January of 2026, the strike price is $150. In this case, the stock price is higher than the strike price. So that means that this option over here is out of the money. It's trading on the open market at $3.85. And let's use the following example over here to figure out what the intrinsic and extrinsic value of this option is. So notice my green line represents the price of the option or the premium of the option that the buyer is paying you. Let's represent the intrinsic value in the blue line and then the extrinsic value in the red line over here. So notice in this example over here, we know that the intrinsic value has to be 0 because this option is out of the money. And because the equation for the price of the option or the premium of the option is equal to the sum of the intrinsic plus extrinsic value, that means that the extrinsic value is completely making up the price of this option over here. And lastly, as we march towards expiration date, what you're going to realize is the decay of this extrinsic value. It's going to start decaying and disappearing until it hits 0 on the final day. So armed with those important concepts, let's look at the first topic in outcome 3, and that's closing down a position that's profitable. Let's look at the following example A over here, where we're in a winning position and we want to close out this trade. I'm going to remind you about the BMNR trade that we started. On November 24th of 2025, we sold 3 options. In this case, the buyer paid us $4.60 per share. And remember that the option expires in about roughly 40-something day, January 16th of 2026, with a strike price of $26. The chart that we're looking at right here is the price chart for the option, not the price chart for the stock itself. You need to be careful about that. So on November 28th, right over here, the option itself is trading at $1.84. So we're thinking about closing the position. Why? Because we sold it 4 days ago at $4.60. Now the price of the option has dropped down to $1.84. So if we buy back this option over here, we're going to be able to close out our position. So that's what we're going to do, is we're going to buy back the option, each share at $1.84. And let's look at our profit. If we sold out at $4.60 per share, if we subtract the costs for us to buy back each share, which is $1.84, that gives us a profit of $2.76 per share. Remember that since we sold 3 options over here, it represents 300 shares. If we multiply 276 by 300 shares, that's going to give us a profit of $828. Let's look at our return on capital by selling out a cash secured put. So in this case over here, remember that putting up the whole money is putting up $7,800 to enter the position. This is our profit of $828 in 4 days. That's a return on capital of 10.6% if we were to close out this winning position now. So to tie this together and point out a few other things, you'll notice that we were able to collect roughly 60% of the width of the premium of $4.60 when we initially sold out the option. To close it, that gave us a profit of $276, and that's about 60% of the width. In your mind, you're thinking about this over here. What happens if I held the option to the end and it expired and I collected the full $4.60? Well, you have to keep in mind that by closing it in 4 days, we were very capital efficient. We made 10.6% in 4 days. And if you had decided that you wanted to capture the full width, the full $4.60, you have to wait an additional 49 days. So what you're looking at in the end is 10.6% versus 17.7%, but you were very capital efficient by closing out the position in 4 days. So in summary for this trade over here, on November 28th, we bought back the option to close out our position. What I have over here is the price chart for the stock and the price chart for the option itself. So on November 28th, the stock was trading at $33.12. Remember, the strike price is $26. Because the stock price is higher than the strike price, we know that this option is out of the money. You also notice on the right-hand side, we had that before. The option is now trading at $184. We bought it back to close the position. So let's look at the definitions of out of the money, intrinsic value, extrinsic value, in relation to the option price or the premium. In this case, we know that this option is out of the money. Therefore, the intrinsic value has to be equal to 0. And at the same time, the option price or the premium is the extrinsic value. Now, let's look at example B over here with Tesla. This example is going to help us understand what an unrealized loss that's sitting in our account looks like. And I re-emphasize, we do not close an unrealized loss position. In this case over here, it's November the 12th, 2025. Tesla's trading at $430.13. You as the option seller decide to sell one put option, which is 100 shares on this stock over here. You'll notice over here that the expiry date of this option is January 16, 2026, which is 40-something days away. In this case, the strike price is $420, and the premium per share that we receive for each stock is going to be $30 per share. I'm going to look at this position over here, and again, this is the price chart for the option itself. So on November the 12th, we sold out the position. We're going to analyze this trade on a different date, which is November 21. So again, on November the 12th, we sold out the option and we collected a premium of $30 per share. On November 21, if we were to look at the price chart of the option, notice that that option is trading at $47.21. Likely the reason why this happened is because the stock price started falling. In this case over here, when you look in your account, I'm going to emphasize that this is an unrealized loss and you don't close an unrealized loss. In this position over here, to help you think about it, in order for you to close this position or why it's showing an unrealized loss, it's because in order for us to close it, we have to go to the open market and buy back that option at $47.21 per share. And we only collected $30 in the beginning. That would result in a loss of $17.21 per share. And since we sold one option, which represents 100 shares, in our account, it's going to show a loss of $1,721. And I emphasize again, you're not going to close out a losing position. So continuing on with this example right over here, remember that there's an unrealized loss that's sitting in our account. But remember what we're doing here. We're only part way into this trade. It's only November 21st, and there's still a chance for Tesla to reverse course because the expiration date is on January the 16th, 2026. Secondly, remember that we're only selling cash secured puts. So after expiration date, if we have to take assignment and own the stock, we're mentally prepared to doing that. And lastly over here, we never buy back a losing position. We're going to ride it out and take assignment of the stock after January the 16th of 2026. Remember that our break-even price is not the strike price. It's not the $420. In this case over here, we received a premium of $30 per share, so our effective break-even book value price is $420 minus $30, which is $390. When you compare that to the current Tesla price right now, you're going to notice that you're buying in at a discount should you have to take an assignment. So notice it's roughly a 9.3% discount from where the current stock price is. And remember my message from before? If you like Tesla now, there's no reason why you wouldn't like them even more when they're on sale. So continuing on with outcome 2, the second very important topic over here is the early assignment. This is a very confusing topic for new option traders or sometimes experienced option traders who haven't thought about this. When I first started trading options, I would always think, why would the buyer not exercise sometime between now until expiration date? You're going to see in our discussion over here that usually this never happens. Talking about early assignment over here, you're going to realize very quickly that the primary reason why the buyer would not exercise early is because they can trade away the option and realize a higher profit than actually exercising it. Let's look at the fundamental equation over here of the option price being equal to the intrinsic value plus the extrinsic value. If the buyer decides to exercise early, the only thing they're going to realize is the intrinsic value, which is the amount that the stock price is under the strike price. By exercising early, the buyer is going to forfeit the extrinsic value, and remember that's the extra value that the market assigns to the option because there's still time value left for the stock to move further in the buyer's favor. So let me use example A over here to illustrate the math behind exercising versus selling or trading away the option from the buyer's perspective. In this case over here, in my hypothetical example, we're going to use two put options. The stock price is currently trading at $30, the strike price is $40, and the premium or the option price is $11. What we're going to do is perform a calculation to show on the left-hand side what the profit the buyer will get by exercising early versus if the buyer would sell that option away or trade that option away to another buyer within the economy. And what we're going to show is that by exercising early, you're leaving extra money on the table from the buyer's perspective. So in this case over here, remember that the intrinsic value is the amount that the stock price is under the strike price. In this case, it's under by $10. And if you know the premium or the option price, the equation says that the option price is equal to the intrinsic value plus the extrinsic value. So if you do the math, the extrinsic value has to be $1. In this case over here, if the buyer were to exercise early, the only value that they capture is the intrinsic value. So when you do the math over here, the intrinsic value is $10. Multiply by 200 shares because it's for two put option. That will give the buyer a profit of $2,000 if they were to exercise right now. We're going to contrast that to the value of the option on the open market. The value of the option means that's the price of the option or the premium of the option. In this case over here, if this buyer goes out there and decides to close out their position by selling away their put options to somebody else, here's the profit they're going to end up making. In this case over here, the value of the option, the price of the option is $11. Multiply by 200 shares. That will give the buyer a profit of $2,200. And that's higher by $200 than if they were to exercise early. Now, there's a few small nuances here. The first nuance is that we assume that there's no cost to the buyer within our analysis over here, and that's why we calculated the profit in this manner. The second nuance is Even though the buyer in this situation has sold away their option, they've closed out the position, another buyer in the economy is now holding on to the option. What this means for you as a seller is that you still have an obligation to fulfill. So any rational buyer over here would either continuing to hold on to the option or trading away the option instead of exercising early. Let's use a real-life example to hammer home the message why buyers would usually never exercise early. In this example over here, it's going to involve Apple itself, and on November of 2025, Apple was trading for $284. This buyer over here is going to go out and purchase one put option that expires on January the 16th of 2026, 40-something days away, with a strike price of $290. What we're going to do is first calculate the profit that the buyer will get should they exercise early versus either holding on to the option or trading away the option. In this scenario over here, we know that because the strike price is $290 and that's higher than the stock price by $5.85, and that represents the intrinsic value. Knowing the premium or the option price, we take 1035 minus 585, and that gives us the extrinsic value of the option over here. On the left-hand side, we're going to make the calculation for an early exercise, meaning that the buyer can only realize the intrinsic value of the option itself. In this case, since only one option is involved, we take 585 multiplied by 100 shares. That will give the buyer a profit of $585. In contrast, if the buyer decides to go out there and trade away their position by selling their option to another buyer in the economy, the value of the option is worth $10.35. And remember, the value of the option is equal to the premium of the option, or the price of the option in this case. Because there's only one option involved, they're going to take 100 shares multiplied by 1035, and notice the total profit that the buyer gets for trading away this option is going to be $1,035 compared to the $585 for exercising early. No buyer would exercise early given this circumstance. So to conclude example B over here, notice that no buyer would exercise early because they're leaving profit on the table. If the buyer were to trade away their option, or if they were to hold on to their option, what they're going to do is they're going to capture both the intrinsic value plus the extrinsic value, which is the time value remaining on the option. Like everything in life, there's always going to be an exception. In this example over here, you're going to see that the option is so deep in the money that it's going to encourage the buyer to actually exercise their position. In example C, for one put option, we're going to look at Amazon over here, which is trading at $232.38. In my example, here's a put option that expires on December the 5th, 2025, that has a strike price of $345. If you compare the strike price and the stock price right now, you immediately realize that this option is deep in the money. So we're going to carry out those two calculations again, one for early assignment, and the other one is for essentially looking at the value of the option on the open market. So in this scenario over here, the amount that the stock price is under the strike price, if you take 345, subtract from 232.38, you're going to get an intrinsic value of $112.62. Since you know what the premium is, if you take 113.85 and subtract it from the intrinsic value, that gives you an extrinsic value of $1.23. Because there's only one option that's involved over here, you'll notice if the buyer were to go out there and exercise their right, they're going to realize the following profit. You're going to take 100 shares because it's only one put option, multiply by the intrinsic value. That gives them a total profit of $11,262. We're going to contrast this to what the value of the option is worth on the open market. You'll notice over here the value of the option on the open market is basically the premium. If the buyer were to go out there and try to trade this away, notice that the profit the buyer is going to come up with is 100 shares for the one option times by $113.85. That gives them a total profit of $11,385. If you were to compare that to exercising early, it's basically a difference of $123 or the extrinsic value over here. Notice in this case over here that because the option is so deep in the money that there will be a chance that this buyer is going to exercise their position. So let's examine the rationale why the buyer would exercise early. In this case over here, it's going to come down to the following concept called the time value of money. By exercising early, the buyer is going to be able to take that chunk of profit somewhere else and invest it in a different vehicle to generate interest. And the dollar amount on that interest is going to be higher than the time value that's remaining on the option. And that's why the buyer would exercise early. Keep that in mind because at this point right here, the option is so deep in the money that the option behaves exactly like the stock. There's very little volatility value that's remaining. For every point that the stock moves, the option is likely going to move by the same amount. Secondly, cash is king because now the buyer has exercised their option. They now have that cash in their hand. By exercising early, they can take that cash, park it somewhere else, and earn more money than the time value that's remaining on the option. So if you made it this far in the course, congratulations, you've learned a tremendous amount with regards to options trading. Looking back on my own learning journey, within the first 2 to 3 years, I could not achieve this kind of breadth and depth with respect to understanding the material. For those of you who may still be struggling, my recommendation for you is to get out a pen and paper, go back, rewatch the examples, work them out, as this will help cement the knowledge within your own mind. So for the upcoming part 2 over here, we're going to look at the most critical part of outcome number 3, which is to defend a losing position. As the saying goes, playing great defense wins championships. In this section over here, we're going to be looking at strategies such as rolling the trade, defending it with a vertical spread, and looking into the wheel strategy. We're then going to present to you the seller's blueprint, which is a framework on how to think about and how to execute selling a cash secured put. This starts off by choosing the right stock, knowing what the right strike price selection is via probabilities, and knowing what the sweet point is of the days to expiration. Then we're going to incorporate volatility and risk management into the overall strategy. If you're finding this content helpful, please consider subscribing to the channel, giving this video a thumbs up, and hitting the notification bell to getting the latest updates.